There's an everything bubble. Everything's in a bubble except gold stocks, right? Or gold. I mean, the things that people should be buying are the only things they're not. You have like a reverse bubble there. And we're trying to figure out ways to gamble with cryptocurrencies while the world is making all the stuff that we actually need. And while we're talking about and we're encouraging our citizens to load up on Bitcoin, the rest of the world, the Chinese, they're buying gold, right? And so this is part of this huge bubble, this Bitcoin bubble, and the stock market bubble, and the housing bubble, and the bond bubble. It is much bigger than what we had in the 90s and the 2000s. And because it's bigger, it's doing more damage to the economy. There are more mistakes. There are more malinvestments that need to be worked out now than there were back then.
In today's news recap, gold prices to tread water in final trading week of 2024. Low holiday trading volume in the final week of 2024 is expected to keep gold prices contained within their narrow range, according to some market analysts. Markets will be closed mid-week on January. So many analysts remain focused on celebrating the new year rather than monitoring financial markets. Barring any major surprises on the horizon, many analysts predict that gold prices will remain caught in a tug of war between rising bond yields and safe haven demand driven by increasing geopolitical and economic uncertainty. This past week, gold prices were capped at $2,650 an ounce. However, the market was able to withstand significant headwinds as the yield on 10-year Treasury notes rallied to 4.64%, its highest level in 7 months. The precious metal remains range-bound heading into the weekend, even as bond yields stay elevated above 4.6%. Spot gold futures last traded at $2,618.30 an ounce, down 0.57% on the day. Meanwhile, gold prices are down 0.18% for the week. Gold's resilience this week has been underpinned by escalating geopolitical tensions. Investors are closely monitoring conflicts in Eastern Europe and the Middle East, said James Hirchik, market analyst at FX Empire, in a note Friday. Israeli strikes against Houthi targets in Yemen and Russian drone attacks in Ukraine have reinforced gold's appeal as a safe haven asset. This geopolitical backdrop continues to keep gold in play, with traders hedging against the risk of further flare-ups. At the same time, some analysts note that social media comments from President-elect Donald Trump expressing an interest in annexing Canada, the Panama Canal, and Greenland have also heightened geopolitical uncertainty and tensions. Gold's short-term outlook remains bearish, with rising yields and dollar strength acting as stronger drivers than geopolitical risks, he said. However, the current move is unfolding during a historically slow trading week, and thinner volumes may limit follow-through. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
And all the things that are, at the center of the bubble, that's what everybody's buying. Everybody is piling in to these bubble assets, from tech stocks to cryptocurrencies, while they're ignoring the out of favor assets that will come into favor, I believe, as the air comes out of this bubble one way or another. And I think the most likely way that it comes out is with massive inflation. I think you see a big decline in the dollar, and so you get real declines in asset prices more so than nominal, meaning it's not the Dow crashes, real estate prices crash, it's that the dollar crashes. And so asset prices are reduced more in real terms than they are in nominal terms, although we could have a little of both. And I've said that we're not going to see any relief. Long-term yields are going to keep rising until the Fed goes back to QE. I think even if we get more weak economic data, it still might not matter because all the economic data that we got this week, and I'm going to, go over that in a little bit, but all the economic news we got this week was bad news. And the bond market shrugged it off. It didn't matter. I mean, maybe if we get a big spike in unemployment or something like that, but even if that happens, which is probably going to happen at some point, I think any rise in bonds will be sold. Yields are headed much, much higher. And it's not just here. It's all around the world. In fact, it may be even more significant what's going on in Japan. Look at the 10-year Japanese government bond. I haven't talked about this in a while, but I talked about it quite a bit when the yields got up to 0.5%. And the Japanese government was kind of drawing a line in the sand, trying to defend the 50 basis point yield because yields were lower. They went up to 50 basis points. And I was predicting that the Bank of Japan would not be successful, or the government, and yields would rise. Well, the yield now on the Japanese 10-year government bond is 1.1%. It's just getting started. So while all the experts are, still scratching their heads trying to figure out this, divergence, right? Nobody expected this to happen, least of all the Fed. Look at what's happening now to mortgage yields. We almost got down to 6% when the Fed started cutting. That first cut, we were down to like 6.1 on a 30-year fixed. Now I think we're back up to 6.85. I think by the first week of January, we'll be back with a 7 handle on the 30-year fixed rate mortgage. That is a very problematic level. It's already problematic now, but it's going to get worse, and it's not going to stop. And I think the Treasury yields aren't going to stop when we hit 5. I think we're going to break through 5 early in January, especially if you look at what's going on with the debt problem. Donald Trump, actions speak louder than words. I hate to say I told you so, but I told you so. But in the first little battle about the debt, right, they had this continuing resolution that they wanted to pass. And the initial bill, was a much more voluminous bill. And at least to his credit, Elon Musk managed to put the kibosh on that one because he put it on X and he showed this monstrosity that they wanted to pass that nobody had a chance to read. And so they ended up passing something that was a lot smaller, but it still did a lot of damage because it still had 110 billion of additional spending. Maybe it had somewhat less than the original bill, but it still passed. And what Donald Trump objected to, he was demanding, along with Elon Musk, he was demanding that the Congress include in that continuing resolution a 2-year suspension of the debt ceiling so that they wouldn't have to deal with the issue and that the sky would be the limit on the debt over the next couple of years. Now, if Trump really was serious about doing something about the debt, he would want to leave that ceiling in place. I mean, that's the only tool we have to reduce spending. Not that it's, worked that well, but I mean, that's the only thing that the Republicans have had up their sleeves is, negotiating the increase in the debt ceiling to try to exact some modicum of spending reduction. But if we've run up, over $36 trillion of debt with a ceiling, right, we're going to run up a lot more without it. Donald Trump didn't want that there. In fact, Donald Trump was out there saying that he wants to get rid of the debt ceiling entirely so that it doesn't even exist anymore. Again, that's all we got.
In the continuation of the episode, Peter highlights the critical role of gold and silver as safe haven assets. Amid growing economic and financial uncertainty, gold prices, which initially dropped $60 following the Federal Reserve's rate cut announcement, partially rebounded, showing resilience in volatile conditions. Despite gold's strong performance this year, up 25%, Schiff pointed out the sharp underperformance of mining stocks like Barrick Gold and Newmont Mining, which have declined more than 30%. Silver also slipped below $30 per ounce, but Schiff described this as a buying opportunity, emphasizing the strategic value of both metals in a challenging economic environment. Schiff expressed concerns about the Federal Reserve's direction, particularly Chair Jerome Powell's acknowledgement that inflation could take up to 2 years to return to the 2% target. He expects the U.S. administration, under growing economic strain, to pressure the Fed into easing further, likely returning to quantitative easing to stabilize markets. However, Schiff warned that such a move would sacrifice the dollar's value, triggering a broader inflationary spiral. The combination of persistent inflation, fiscal irresponsibility, and a potential recession creates a bullish case for gold and silver as long-term hedges. Bitcoin also featured prominently in the discussion. Schiff noted that Bitcoin recently hit a record high above $109,000 before falling below $100,000, reflecting extreme volatility in speculative assets. He dismissed the idea that the U.S. would ever declare Bitcoin a strategic reserve asset, arguing that the incoming administration would face far greater challenges such as managing inflation, financial instability, and a potential recession. While Bitcoin's meteoric rise has captured attention, Schiff remains skeptical of its long-term value compared to gold and silver. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
The stock market bubble in the 1990s and the tech bubble, and that popped. And then we had the housing bubble in the aughts. Right. And that popped in 2008. We had the financial crisis. Well, the bubble we've got now is much bigger than both those bubbles combined. We got a bubble in stocks and a bubble in real estate, but we also have a bubble in bonds, even though the air is coming out of it, it's still there. We got a bubble in the dollar for sure. We got a huge bubble in crypto. I mentioned that Bitcoin alone already has a bigger market cap than all the dot-coms that went bankrupt. All 400 dot-coms that were publicly traded that went bankrupt at their peaks weren't even worth as much as Bitcoin. Forgetting about all the altcoins, Ether, the other ones, all the stocks, MicroStrategy. 2 or 3 more companies have come out in the last week, and they've announced that they bought Bitcoin. They added Bitcoin to their balance sheet. Now, these companies all, in one way or another are related to crypto and stuff like that. So it's not, they're in the industries, but they're still taking cash and buying Bitcoin, and, the market is rewarding them. But, how many companies can do the same thing that MicroStrategy is doing? Because now they're getting a lot of competition in the we issue debt and buy Bitcoin business, right? That's their business. They're not a software company. They're in the business of buying Bitcoin and paying for it by issuing stock and debt. By the way, MicroStrategy stock ain't looking so good right now. It's now almost down about 40% from its peak, a couple of weeks ago, 2-3 weeks ago. And the last time they announced a buy of Bitcoin, and they announce it every Monday, so I'm sure we'll get another buy on Monday. But this Monday, they announced a buy, and their average price was like $106,000 for the Bitcoin. That was their highest print. And they only bought about another $500 million, which is still a lot to pay for nothing. But as I'm doing this podcast now, Bitcoin is barely hanging on to 94 handle, 94,400. So MicroStrategy is way off on that buy, but the technicals are really starting to break down. As a joke, because the thing that's been powering Bitcoin is the fact that they're going to be a Bitcoin reserve. Well, there's going to be no reserve, right? There's been no talk about that. I mean, it's not going to happen. But they got to keep the potential out there. So there'll be articles about it. But Trump has much bigger fish to fry. He's not going to waste any political capital trying to get this Bitcoin reserve done. So it ain't going to happen. And so at some point, the market's going to crash because that's basically what's holding it up is the fact that they think the government's going to come in with the big government bailout. But I joked and I said, look, if the U.S. government really wants to own 5-10% of a cryptocurrency, why buy one? Just start your own. The U.S. government can come out with its own crypto. Yeah, it can make a limit, hard cap at 21 million, no problem. Right? Just come up with your own and endorse it. And so I floated the idea and I said, how about USA coin? And I had Grok, come up with a coin with a picture of Trump and Elon Musk on a gold coin that looks like the way they represent Bitcoin. And I said, hey, here's how it could look, right? This is how we could represent it. And let's call it USA coin and, save the taxpayers some money. Instead of paying $100,000 for a Bitcoin, just, these could come out for pennies, whatever, just like Bitcoin did. And so instead of making the Bitcoin hodlers rich, just, save the taxpayers the money and just buy this new coin. What the hell difference would it make? I mean, because they could still use it. They could still dominate that coin. And in fact, if the U.S. government came out and said, hey, this is the coin that we like, and hey, we can't print it. It's hard capped at 21 million. We can make it legal tender. We could actually put it on a blockchain and make it capable of functioning, much better than Bitcoin, make it faster, make it cheaper, make it actually work as a currency. Yeah, why the hell not? I mean, not like I really want them to do it, but if they wanted to do it, I mean, sure. So I put it out as a joke. Your next thing I know, some guy actually launches one of these coins. It did like $10 million of trading in the first day. And as soon as I saw it, I had to go on and post, hey, don't buy this thing. I joked about it. Some of these Bitcoin guys don't understand sarcasm, or they just thought that they could take advantage of it and screw some people out of the money, which is what happens. But I've heard now there's another one coming out. There's a ICO. I don't know, but stay away from this. I mean, I try to back away from it or tell people not to buy it, that I wasn't serious. I said something like, Bitcoin is for losers, USA coin is for winners, hold it to the moon, whatever. It's just all, the crypto nonsense. But they went out and created it. But the point I was making before I went off on that tangent is Bitcoin is a massive bubble too, right? And there are distortions. I mean, think about all of the capital that has been wasted on Bitcoin and blockchain related companies, right? That don't produce any products that we need, that don't generate any profits. They just generate returns for the shareholders because the price goes up because some idiot is willing to buy their stock. Meanwhile, the rest of the world is building real things, right? Making real stuff. That's one of the reasons our trade deficit is going up, is because instead of producing real goods, we're creating cryptocurrencies. And we're trying to figure out ways to gamble with cryptocurrencies while the world is making all the stuff that we actually need. And while we're talking about and we're encouraging our citizens to load up on Bitcoin, the rest of the world, the Chinese, they're buying gold, right? And so this is part of this huge bubble, this Bitcoin bubble and the stock market bubble and the housing bubble and the bond bubble. It is much bigger than what we had in the 90s and the 2000s. And because it's bigger, it's doing more damage to the economy. There are more mistakes. There are more malinvestments that need to be worked out now than there were back then. And making it even worse, all of this is happening at a time where the underlying structure of the economy that this bubble is built on top of is fundamentally weaker. We're in worse shape economically than we were in the 90s or the 2000s. We have a lot more debt now than we did then, right? So when this everything bubble pops, and it has to pop, the consequences are far more catastrophic than what we had in 2001 or 2008.
Do you agree with Peter's take on the Fed's hawkish pivot, the future of gold and silver, and the potential fallout for markets and the dollar? Or do you have a different perspective on how these policies will play out? Share your honest thoughts in the comments below. We want to hear your opinion on this evolving situation. Let's keep the conversation going and explore what these developments mean for all of us navigating these uncertain times. Don't forget to like, subscribe, and hit the bell icon to stay updated on our latest content. See you in the next episode.